The stunning problem with the 4% rule in one chart, says Robert Pagliaroni. I just remember Pagliano, Pags, Joe Pags from Philly, and then they had a Pagliano from the Yankees. I remember that. Joe Pags, a good sports show. I liked that a lot when I lived in South Jersey. All right, Dateline, January 22nd, 2020. Let's see what we got here. Are you in the retirement bubble? Is the few years leading up to retirement and the first few years in retirement when your retirement nest egg is most vulnerable. Why? Because it's a sequence of return risk. Sequence of returns is most dangerous when you withdraw money from your portfolio. Well, we know all that. But I keep hearing, doesn't the 4% rule protect me? The short answer is it does provide some protection. Based on the research used to develop the 4% rule, it found that an initial withdrawal of 4% from a portfolio was the highest withdrawal rate over the time period that did not leave the retiree broke after 30 years. Does that mean you're guaranteed to never run out of money? Of course not. Well, he didn't say it. He says no. Let's look at 3 examples that use the following. Annual portfolio return of 5.5%. Time frame 30 years, starting portfolio value, an annual withdrawal of $40,000. This is 4% of the portfolio starting value. I've already read this, and this is why we an annual withdrawal of $40,000? I don't understand. That's not what the 4% rule says. I don't get it. But anyway, let's keep thinking. You may be thinking we are withdrawing the same amount of money. We're starting with the same amount as $1 million. We're taking and the average return is 5.5% a year. What would be the difference? Won't the results be identical? No. Hopefully, you guys are keen enough to recognize that there is a sequence of return risk, and that just means just because you got 5.5% a year doesn't mean it's flat. All right, so here we got a strong start. Average annual return, 5.5%. We start at 20, 25, 30, then 15, 10. You can see it goes down, I think we had 1 year it jumped up a little bit, to 10, 11, 10. Then we have a couple bad years at the end. In this case, we're leaving ending balance. We're leaving $2.8 million to our heirs. Actually, let's see. Beginning balance, ending balance, post withdrawal. Why is the beginning balance and ending balance that much different? I don't get it. Oh, because it dropped. Okay, gotcha. All right, so there we go. All right, so we start the year 30 with 3.7 million. We ended with 2.8, but we had to take 40,000 out, and we were left with 2.78 million. All right, well, that's fine. Let's see what happens if we get a flat 5.5 rate return. Well, this should be fine because we're only taking 40,000 a year out, and we're getting 5.5 per year as compounding. This doesn't make any sense to me, but let's go. So that's all fine. So let's go to the negative one. Bad start, strong finish. All right, so a couple things. So we're literally taking 40,000 a year out each and every year without adjusting it for inflation, which I don't understand because the returns are compounded. So that's weird to me. We got $1 million. We're down 25% the first year, which we're down to 710 after taking 40,000. Down 20% the second year, we're down to 528 after taking the 40,000, and that's the sequence of return risk right there. And I think we don't even have a negative. Yeah, we don't even have any other negative years other than those 4. And we ran out of money in year 15. And if we adjusted for inflation, it'd be a lot worse. It's just an odd thing. I don't get the 40,000 a year fix. That's just odd to me. Now, let's look at this too, by the way. When did this ever happen in terms of the returns being that bad? So let's go to the spreadsheets. All right, so we're going to look at let's look at the S&P 500 and see when that ever returned that bad. And the answer, so he's like negative 25. He's negative. We go back here. So we got negative 25, negative 20, negative 15, negative 10, negative 5. Has that ever happened before? All right, so we go to 1871 with the S&P 500. Oh man, I got to figure that one out. Nope. And you can see here, these are the years, the returns, and nothing. In the 1800s, nothing. I'm looking for 4 consecutive negative years like that. I already know the answer. I'm going to share with you. No, nothing. Nothing. 1907, 1903, nothing. We got 1913 to 14, less than 10% total. 1917, the start of World War I, nothing. 1920. And then the worst we've ever had was 1929, 1930, 1931, and 1932. The worst we've ever had, 1929, 1930, 1931, and 1932. All right, well, That's it. Now, in 2000, 2001, and 2, the market were down 9, 12, and 22% respectively. But this is the worst by far. 1929, 1930, 1931, 1932. You know what inflation was back then? Well, we had significant deflation. Here's the inflation rates from 1929. Zero deflation 1930, 1931, and 1932, where significant deflation going to 1933. So we've never had where inflation and a significant negative market killed us. In fact, this deflation took some of the steam, the negative stuff, off the returns that we had here. So you factor in 9, but we have a deflation. There was we had deflation basically 10% each year here, and then another like 5% deflation here. So that's the cost of goods are going down, even though the market was going down. So there's never been anywhere near the other than 19. People say, what about 1973 and 74? Well, that was bad for sure. 1973 down 15, 1974 down 26. That's it, though. That's what I'm saying, man. I mean, the history of the U.S. stock market is not one of many sequence of return risks that you would have to, oh my goodness, we're all going to die. That's why I talk about the barbell. But let me pause a second. In the Wellington Fund and taking 4% a year out, adjusting with inflation, you do not run out of money. In fact, by the time you die 30 years later, you got 150,000 left, and you've been taking out. You can see where the inflation judge. You're taking about 7,000 a year. So even during 1930, when you guys smoked, this is the Wellington Fund, we still got smoked for 2 consecutive years. Not that big of a deal. And so if we even go here. Starting in 1930, you could take 4% a year out, adjust for inflation, and 4% a year fix, and never ran out of money. Now, even if you took 5% a year out, adjusted for inflation, you still had money for 29 years. The likelihood of you living beyond those years is very small, but you did have money 5% a year adjusted for inflation, and that's during the Great Depression years, where the Wellington got smoked in those 1930 and 1931. So this whole sequence of return risk actually bothers me, because everyone's like acting like this is somewhat inevitable or it's a high probability. It's just not. Now, again, I go into Japan, and I just went down. Hold on a second. I'm going to show you again, this is from my book, by the way, that I'm going to use here. Hold on, let me pause it. And here's a real life scenario of Japan, 1990, 1991, 1992, 1996, 1997, 1998. So you got smoked in Japan, and you ran out of money for sure. But you think a 4% would have saved you back then? No, this is a 5% initial withdrawal. If you had 4%, you would not have been saved. If you have a negative sequence of return, a bad sequence of return risk, a la Japan, your goose is cooked. There's no getting around that. Even if you have 3 years of cash. Even if you have 3 years, or Wellington, it doesn't matter. Your goose is cooked. So I mean, that's the issue that we have to contend with. Is there is always a risk to markets, and just because you can avoid the sequence of return risk, just because there is a sequence of return risk, that doesn't happen often. If it did happen, it stinks. I mean, this is why you got to be prepared for sure. But but it can certainly happen in Japan. It certainly happened here too. We just haven't seen it that often. And if you just take some basic precautionary measures, i.e. keeping some money, 3 to 5 years in cash, or the Wellington Fund or something like that, you should be good to go. Now, no guarantees. We could be going into a Japan where we have significant down markets. But remember, man, the Japanese was such a bubble back then, such a bubble. We're not anywhere near that here in the U.S. It's just not. Now, if the Bolsheviks take over, Black Lives Matter, Antifa, well, that's a different story. But that's the whole point why you just pay off debt, keep some cash, and just pray and hope for the best, because what's he going to do? All right. Anyway, it's a pretty interesting article. The premise is just odd to me. So, anyway, love to hear your comments. Thanks now.